While the strength of the equity market in the first half of 2019 was based on a reversal in monetary policy, it currently contradicts the deteriorating economic situation. The signals the central banks are sending the markets can clearly be interpreted as supportive. But will that be enough? While the ECB has never really been in interest rate hike mode, the Fed has already raised interest rates 9 times since the end of 2015. However, it recently deviated from this course and reduced the Fed fund rates again for the first time at the end of July. I would like to explain what has caused the central banks to rethink their position using 3 main points. While the US continues to grow solidly, Europe and China are struggling. We cannot rule out a recession in Europe, and the manufacturing industry is feeling considerable downward pressure. Profit warnings from industry giants such as BASF and Daimler emphasize the weak sentiment. The central banks have reacted to this and announced further easing of monetary policy. President Trump likes to position himself as a man of action. Tax cuts, a strong labor market, and record stock markets. He even openly called on the Fed to cut interest rates, and it came, albeit with a delay. Lower interest rates are driving the stock markets, and with a little time lag, the economy is also benefiting. Trump cannot afford a weak economy or stock market before the upcoming elections. An excessively strong US dollar would weaken the American export industry. Without a clear signal from the Fed, the interest rate differential with Europe would have continued to grow, weakening the euro even more and in turn further strengthening the US dollar. As mentioned earlier, we are increasingly receiving profit warnings from established companies in the industrial sector. The increased valuation of the stock markets needs significant profit growth, which is not a given under current conditions. We therefore anticipate a weak economy during the summer months, particularly in Europe, and expect volatile and difficult stock markets. Accordingly, we have reduced the equity allocation in all of our ETHENEA funds. We do not plan to adjust this until the measures taken by the central banks translate into positive growth, and this gives the stock markets a boost.